You walk into a bank with $100. You hand it to the teller. They smile, take your cash, and put it in a vault. That money is now yours, sitting safely in an account with your name on it, right? Wrong. That $100 doesn't stay in the vault. In fact, within minutes of you walking out, the bank has already lent 90 of those dollars to someone else. And here's where it gets strange. That person deposits the $90 into their account at another bank. That bank then lends out $81 of it, then $72, then $65. Your original $100 has now become $385 in the financial system, and no one printed a single new bill. This isn't a glitch. It's not a loophole. This is exactly how banks are designed to work, and most people have no idea it's happening. Let's start with a question that sounds simple, but isn't. Where does money actually come from? You probably think the government prints it. And technically, yes, the Treasury prints physical bills, and the Federal Reserve manages the money supply. But here's the uncomfortable truth. More than 90% of the money in circulation today was never printed. It doesn't exist as cash. It exists as numbers in a computer system. And most of it wasn't created by the government at all. It was created by banks, your bank, my bank, every time someone takes out a loan. This is called fractional reserve banking. And if you understand this, you understand why inflation happens, why banks collapse, and why your savings account pays you 0.01% interest while the bank charges 18% on credit cards. Let's break it down. Imagine you're a kid with a lemonade stand. You make $10 on Saturday. You're proud. You want to keep that money safe, so you give it to your older brother and tell him to hold on to it. He agrees. You feel secure. That $10 is yours. But your brother is clever. He realizes you're probably not going to ask for all $10 back at the same time, so he takes 9 of your dollars and lends it to your neighbor who's starting a cookie business. Your neighbor agrees to pay your brother $11 next month. Your brother pockets the extra dollar as interest. Now here's where it gets weird. You still think you have $10. You can check with your brother anytime, and he'll confirm it. $10, all there. But your neighbor also thinks he has $9 because he's holding that cash right now. So in your little neighborhood economy, there's now $19 in perceived value, even though only 10 physical dollars exist. Your brother just created $9 out of thin air, not by printing money, but by lending it. That's a bank. Now let's scale that up, way up. In the real financial system, banks are required by law to keep a fraction of deposits on hand. This is called the reserve requirement. For decades, that number was around 10%, meaning if you deposited $100, the bank only had to keep 10. The other 90 could be lent out immediately. But here's where it gets more interesting. In March of 2020, the Federal Reserve dropped the reserve requirement to 0. That's not a typo, 0%. Banks are now legally allowed to lend out 100% of your deposits if they want to. Most don't because they need some liquidity to process withdrawals, but the point stands, there is no rule anymore that says they have to hold on to your money. So what happens when that money gets lent out? Let's say you deposit $1,000. The bank keeps $100 and lends out $900 to someone buying a car. That person doesn't take $900 in cash and stuff it under their mattress. They use it to pay the dealership. The dealership deposits that $900 into their bank account. Now that $900 is a new deposit, and that bank can lend out 90% of it. So they lend out $810 to someone else, who deposits it, which gets lent out again, and again, and again. By the time this cycle completes, your original $1,000 deposit has turned into about $10,000 in total credit circulating through the system. Economists call this the money multiplier, and it's how the majority of money in modern economies is actually created, not by governments, by banks, through debt. Let's pause and sit with that for a second. Most of the money you use to buy groceries, pay rent, or save for retirement is not backed by anything physical. It's a ledger entry, a promise, a number in a database that says you're owed value. And it only works because everyone believes it works. This system has a name. It's called fiat currency, money by decree. It has value because the government says it does, and because people trust that other people will accept it. There's no gold in a vault backing your checking account. That ended in 1971. Before that, you could technically walk into a bank and exchange your dollars for gold. It kept the system somewhat tethered to reality, but President Nixon severed that link, and since then, money has been fully abstract. The only limit to how much money can be created is how much debt people are willing to take on and how much banks are willing to lend. Which brings us to a very simple question. What happens if everyone wants their money back at the same time? Let's go back to your brother. You gave him $10. He lent out $9. But one day you need your $10 back. All of it, right now. Your brother panics. He only has $1 in his hand. He tells you to wait. He runs to your neighbor and demands the $9 back immediately. But your neighbor spent $6 of it on cookie ingredients. He only has $3. Your brother is short. He can't pay you. And if you tell the other kids in the neighborhood what happened, they're going to freak out too and demand their money back. This is called a bank run, and it has destroyed financial institutions for centuries. The most recent example, March 2023, Silicon Valley Bank, the 16th largest bank in the United States, collapsed in under 48 hours, not because it made risky bets on subprime mortgages, but because depositors got spooked and tried to withdraw their money all at once. The bank didn't have it. They had lent it out, invested it, and when everyone showed up demanding cash, the system broke. Silicon Valley Bank had over $200 billion in assets. But assets aren't the same as cash. Assets are loans, bonds, investments, things that take time to convert into money. And when you don't have time, you collapse. The FDIC stepped in. The government backstopped the deposits. The system survived. Barely. But here's the uncomfortable part. That wasn't a bug. That was the system working exactly as designed. Banks are inherently fragile because they operate on the assumption that not everyone will ask for their money back at the same time. It's a confidence game, and the moment confidence cracks, the math stops working. So why do we allow this? Why design a financial system that runs on borrowed time and imaginary money? Because it works, most of the time. Fractional reserve banking allows economies to grow faster than they would if money supply were fixed. If banks could only lend out money they physically had, there would be far less credit available. That means fewer business loans, fewer mortgages, fewer car loans, less economic activity overall. Credit is the fuel of modern capitalism, and banks are the engine that creates it. By lending out deposits, they effectively multiply the money supply. That enables investment, growth, innovation. The entire economy runs on this system. But there's a cost, and the cost is risk. Because when banks create money through lending, they're also creating debt, and debt has to be paid back, with interest. If borrowers default, if the economy slows down, if confidence disappears, the whole thing can unwind fast. We saw it in 1929, the Great Depression, bank runs, mass unemployment, economic collapse. We saw it again in 2008. The housing market crashed. Banks had lent out money they didn't have to people who couldn't pay it back. The system seized. Lehman Brothers collapsed. The global economy nearly went with it. The government bailed out the banks, printed trillions of dollars, and everyone moved on. But the structure didn't change. The incentives didn't change. Banks still create money the same way. They still operate on the assumption that depositors won't all ask for their cash at the same time. And next time, the numbers will be bigger. Here's the part that doesn't get talked about enough. When banks create money through lending, they're not just creating value, they're creating inflation. Think about it. If the supply of money increases, but the supply of goods stays the same, prices go up. More dollars chasing the same amount of stuff. That's inflation. And while central banks get blamed for printing money, the truth is most new money enters the economy through private bank loans, mortgages, business credit, car loans, student debt. Every time a bank approves a loan, they're adding to the money supply. And every time someone pays off a loan, money disappears from the system. That's why central banks obsess over credit growth. It's not just about lending, it's about the expansion or contraction of the entire money supply. And here's the irony. When inflation gets too high, central banks raise interest rates to slow down lending, but that makes it harder for people to borrow, which means less money gets created, which slows the economy, which can lead to a recession. So, the same system that creates growth also creates the conditions for collapse. It's a pendulum, and no one really controls it. They just try to manage it, smooth out the extremes, keep confidence high enough that people don't panic. But confidence is a fragile thing. Let's zoom out one more time. What does all of this actually mean for you? It means the money in your bank account is not sitting in a vault. It's a liability on a balance sheet, a